What if we told you there were still legal ways to lower your 2025 tax bill, even though the year is already over? And what if we told you that most business owners miss out on these, not because they don't qualify, but because their books aren't ready? Today, we're talking about last-minute tax planning moves, SEP IRAs, traditional IRAs, 401k profit sharing, HSA contributions, and the real secret weapon behind all of them, accurate bookkeeping. If you wait until tax season to think about this, you're already behind. So let's fix that. Welcome back to Unfiltered Profit. I am Seanna Asper, CPA and co-founder of Prospera Strategy with my fearless business partner, Caitlynn Eldridge. And we are working with growing service-based businesses, typically between 1 and 20 million in revenue. And we help them stay ahead on taxes, clean up their financials, make confident in business decisions with real numbers. So today we're talking about last-minute 2025 tax planning strategies. Specifically in this episode, we're going to talk about SEP IRAs, traditional IRAs, 401k profit sharing, and HSA contributions. These are tools that can lower your taxable income, but they only work if your bookkeeping is accurate and your planning is intentional. Have you ever wondered if there's anything I can still do before I file to get that tax number down? This is the episode for you.
And
let's dive into it, Caitlynn.
Legal. They're all legal. We're all allowed to do these. And
no gray area, no nastiness, no weird feelings, no audit risk involved.
I love these ones. What I love about these is their retirement and their health, and they're for you. So it's you saving you money for future you, which is just the best way to do this.
Yeah. If you've been around here very long, you know that retirement contributions are our number one favorite tax strategy over here.
They are. I was just reading, we're going to side note this real quick. I was reading today that like the average Social Security payment is only $3,000 more a year than the annual poverty level for two people. Like, we cannot retire on Social Security. And so the first place you should turn when you say, I want to save money on taxes, is retirement, because I don't think any of us want to work forever. And so it matters, and it can still be done. So you still have time for all of these. We're not hitting you after the fact. You can come in and get this done. So last minute tax planning is really kind of in this last final pool. And that's the fact that we have the ability to contribute to some of these accounts by $315 if you own a business, or $415 for a traditional IRA. If you extend your business return, that 1 due $315, a lot of these actually can be made up to September 15th. So you can still get the tax benefits. You can still put that money for the prior year and still put money in for 2026. And you've got lots of time to do it. So this is not something that you have to panic about, which is really nice.
And if you're sitting there and you're like, okay, my books aren't ready for me to do any of this. Like, as you listen to this episode, my books aren't ready. My money's not ready. Guess what? File the extension, give yourself some more time. Like, this is a game that you can play because of those deadlines. I've seen it done time and time again with clients that want to make a certain SEP contribution. And it's like, okay, well, then we're going to extend because the cash will be there at that point.
Yep. So you'll extend your business return and your personal because they flow into each other. Yep. And now we have until September and October. You still have to have your taxes paid by $415. Please don't get me wrong. But if you factor that tax bill with the SEP contribution, there's a lot of cash planning. This is why you hire professionals. But let's dive in to probably one of, I think it's my favorite because it's so flexible, and that's that SEP IRA. Because for any level of business owner, you have this option. So if you're a Schedule C sole proprietor, if you're an S Corp, if you're a corporation, like, you have the SEP IRA options, and it's designed for self-employed individuals. Contributions are based, though, on a percentage of your net earnings or your gross payroll. And so that's where we say, hey, that bookkeeping matters because you can't go over. So we need to know what that final number is. So if we're in March and you're like, I still don't know what I made last year, then we can't give you an accurate number on that SEP.
Yeah, I know it sometimes feels like we're beating a dead horse when we talk about clean books, but it really is the basis for making all of these decisions. Like, it's not just fantasy.
No, and it just changes the discussion, because I know for the clients that we work with, what the discussion becomes is, this is the max because we know what went on. So we can give them the max number, and then we can say, but here are also the savings at this level and this level and this level. And so now you have options. Okay, well, what makes sense for my cash flow? What do I really want to save? Does this work? But we have time. And if you're up against the deadline and you're in a rush, you don't have that. And so when you come and you say, my tax preparer never does anything, or we never save taxes, were your books ready to go so that you had the option to have those discussions?
Yeah. Have we talked about the SEP on here and how I know it becomes this like favorite retirement plan to be used, but we also have to factor in that it's not always the best when people have employees. So you do have to balance all of those different pieces, because it might make sense for you to have a SEP if you're a sole business owner. But if you have employees that you would also have to pay in for, we don't want to shoot ourselves in the foot just to save on taxes when we're depleting cash. And so it is a complex decision.
It is. And there's that way. So the thing that we're referring to is with a SEP is the percentage that you're doing for you, the owner, you're actually needing to do for the employees if they've been with you X amount of time, have worked full time, all of those things. Like, there's all of these boxes to check. And so if it is just you, one of my favorites, again, super simple to do, easy to put that math on once the books are cleaned up. But if you have employees, we do start talking like, in order to max you out, now you're maxing these employees out, and that cash looks a lot different. And if now I'm having to pick between you doing retirement or you paying your tax bill, I gotta have you pay your tax bill, because the IRS doesn't take kindly to not being paid. For lack of better terms, they get real mad.
Yes. You still must be compliant. Cannot give that piece up.
No. So again, business oriented, you need to be self-employed. It still falls into the brackets of like the max you can put away for the year. We are tied to your net income if you're a Schedule C. We are tied to your wages if you are a S Corp partnership, well, S Corp, C Corp, that kind of thing. And then again, with the SEP, you have employees to worry about if they have met the requirements, which I hate to say things off the top of my head. I want to say it's 2 or 3 years. If they've been with you 2 or 3 years, 3 years in a full-time capacity, part-time capacity.
Yeah, we won't get into the specifics there since this isn't about that, but there are requirements as employees have been there for a while. So you can get away with it for a couple of years, and then you might need to convert to a 401k or something, a simple IRA, something else that makes more sense. So you're not automatically having to put 25% of your employee's salary in if you put 25% of your own in. Because that one will catch you.
It will.
It will be lots of money.
And these come from the business. So the SEP comes from the business. It comes from the business bank account, flows to the fiduciary, whoever's holding your account. That's where it goes. So this is not something that comes out of your personal pocketbook or your personal bank account or the employee's personal bank account. So those are the SEPs. And again, the nice part is you have till 3/15. If you extend, you have till 9/15 to make that payment.
So pay yourself and reduce your taxes.
Yes. When we talk about saving, and if you want the like back of the napkin math, what is your tax bracket for the IRS and for your state? Every dollar you put into that SEP saves you whatever cents that is. I just did a calc yesterday for someone. It was 29 cents. So every dollar saved her 29 cents, which is almost a third. And that becomes a lot more attractive.
Yeah. Especially when you consider that it's not just like an expense where it's something you purchased and yes, you get the use of whatever that is, but this is literally paying yourself in the future too. Like you still get that cash. It's not going to someone else.
But because it's pre-tax dollars, it is taxed on the other side, both the amount you put in and the earnings. So keep that in mind. If your financial planner is like, we're not sure we love this, that might be why. They might not love the idea that future you is taxed. They just want you to take the hit now. And that's okay. Yeah. That is a discussion to have in depth with your financial people.
Yes.
Which we highly encourage. Okay. So
traditional IRAs, let's talk about those.
These are personal ones. These come out of your personal pocketbook. Your business has nothing to do with it. So this is no matter whether you are an employee or you own a business, the traditionals are there. They also have caveats. They have income limits for whether or not you can deduct it. whether or not you have like a plan you can participate in. And that means the tax savings piece. You can put money in. Like you can put $7,000 in for 2025. It's just whether or not you can deduct it. And when we talk about tax savings, we talk about deductions. But yeah, these are personal ones. If you are married and one of you works, both of you can have one. And so typically, though, they are like an earned income item. You need to have some earned income, at least the amount you want to put in. So you can't go around opening these traditional Roth or traditional IRAs for your kids if they don't have earned income. Allowances do not count. I've had that discussion recently, but they don't. I'm sorry. Now, if you want to put them on like start a business, put them on payroll. Again, different discussion, but thanks for mowing my yard. Here's $10. That is not going to count, unfortunately. But yeah, these, again, you have till 4/15 to put in. So this one you can't extend though. Like this is 4/15. If you want to get it in for 2025, once the clock strikes midnight, we're in 2026 now. And that's just where your contribution is going to land. And you don't have that benefit. For some preparers, they want you to put that money in before they'll file that return and say that that's the plan. So I know sometimes people want to like use some of their refund to do it, and some preparers might do that. But if you miss and you don't get this done in time and correctly, you're going to have to go amend your return, and your tax preparer is going to charge you to do that. So I do recommend making the payment first, if at all possible, and then like reimbursing yourself with your refund with whatever savings you gained from this.
I do feel like the traditional IRA is the one where, like, if you're listening to this and you and your spouse have a W-2 and you just came across this podcast, or if you're listening to this and you just have people in your life that are like, how do I save on taxes? I don't have a business or anything. The traditional IRA is a great option. Yes, you have to balance that same consideration with the Roth IRA if you are still allowed to contribute to that from an income standpoint, although there are backdoor ways of doing that but not getting the tax benefit. But this is a piece that I feel like a lot of people just miss when they're a standard W-2 going about their business and they're like, well, I don't want to pay so much in taxes. Are you contributing to your traditional IRA?
Yeah. And if you're lower income, there are credits for contributing to retirement plans. And so all of those can combine. So if you stumble upon us and you're like, Caitlynn, I'm not in this income tax bracket you're talking about, even something can actually get you a little bit extra back from the government. Because again, as we talked about at the top of this, Social Security just is not sustainable for a lot of people. And so it's a really great tool, talking the backdoor Roths and stuff like that. Traditional IRA things to keep in mind, they are going to be taxed again in the future. Can't access it before 59 and a half, tax-free, like without penalty. So you can get it sooner, you're going to pay a penalty plus taxes. You can load that thing up, and then as you get older, you can consider conversions. Like it's a very malleable retirement account. And I think for that, it's pretty nice. There are exceptions for pulling money out that continue to get written into law. So there's just a lot available that you should be talking when you sit down with your tax person, but you have to know your AGI. So again, we're back to like, you need to have some concept of what's going on in your tax money life, be somewhat prepared so you can have those discussions without getting inaccurate information. Because if you show up and you're like, I want to do a traditional, and they tell you you can do $7,000 each, and it turns out you're above the limit to deduct it, well, now you don't have tax savings.
Yep.
Which can make people mad, and we don't want that. So we just want you aware of what's going on. Easiest way is if like things are the same year to year, pull up that tax return from last year, see what that AGI number is, and come prepared.
All right, next one, 401k profit sharing.
We have one of those. Well, we have a 401k. We did not profit share this year.
Yes. But you still have time for the profit sharing piece of the 401k. And that's solo 401k, normal 401k.
Yeah, and let's define. So profit sharing is above and beyond what the employees deferred or what you matched through the year. The concept is the business did really well this year and you want to share that profit with your employees. You want to give them some of it yourself as well. And so again, because you don't close your books to 12/31, we get some extra time to say, okay, well, what did we make? What do we need? What can we give? So 3/15 is the original due date, 9/15 if you extend to get that profit share piece into everybody's accounts.
Yeah. So definitely if you're in a place where you want to give cash to employees as that benefit and get it for yourself, is a great way to save on taxes, get that expense on the books as a business owner. They have specific formulas, I think, that you can opt into for what exactly that looks like to stay in the guidelines of the 401k profit sharing. So it's not something you just do willy-nilly, 100% to you as the owner and nothing to anybody else type of situation.
Unfortunately not. Yeah, highly compensated employee. So the concept is you can't just go and share to yourself. You have to share to everyone. Here's like the extra savings that no one talks about though. Instead of a bonus. So let's say you were going to give everybody a bonus in March for last year's work. If you profit share instead, nobody owes FICA taxes on that. So like you have saved taxes, you've taken a deduction, and you don't have like, let's say it was $5,000 each for whatever reason, that's the math. It's not $5,000 plus FICA, it's just $5,000 that you're giving. So this is a super powerful option for tax savings across the board. And again, making your employees really happy. I mean, I know some would prefer the money in their pocket, but sell it. Sell like the whole story to them that they don't have withholdings on this either. And it gets to grow and they get to have that money in the future. But this is kind of in that double whammy of a way to really save money on taxes and to make your employees happy and to recognize them for a job well done.
Yep. I love it. I love talking about retirement and tax savings all in one.
It's a good one. And if you're like, Caitlynn, the 401k has to be set up, right? So that's the one piece. This needs to be set up. We prefer a safe harbor 401k to a traditional because the safe harbors are less expensive to run. So if you're like, I have passed all of those now, have that discussion now for 2026.
Yes.
And get it all sorted.
Come quick in the year for getting them set up.
Like a lot of companies who set them up say August is the deadline because they have to be in place by end of September.
Yep. Yeah. So you have to start thinking now about it. And then especially if you're switching from like a solo 401k, you know, you're going to hire a team this year. Mm-hmm. Then you have these rules around what retirement plan can you have while you actually have W-2 employees. So there are some pieces that you have to think about the full year growth and what that looks like for a retirement plan for yourself and for your team. So think about it early so you can get all those pieces in place. Because once that 401k deadline passes, that option is gone. It doesn't mean that you couldn't open a SEP IRA for a year and then do a 401k the next year. All of those options still exist. But if that's not what you want to have in place or you don't fit certain rules around things, you've just got to keep those in mind.
You do. And the power for the 401k and tax planning too is the deferral of your compensation and your employees' compensation. So again, the longer you wait, the less people have like that extra cash sitting around to defer. So for a solo 401k, I think in 2026, we're talking like $72,000. So if you're like just swimming in it between the deferrals and the profit sharing, you can put away a lot of money. Don't let that like discourage you and you don't do it. But for a solo, super powerful. For employees, it's nice because you can control the cost because you control the match, you control the profit share, while still being able yourself to defer whatever amount you want to. I like these. I know it's simple. If you can't meet all of the things, might be a better option, but I really do like the power that can be held in a 401k for somebody who's making a lot of money.
Yeah, agreed. And I know one of the things they say is like, they as in financial advisors, they're like, well, I don't like the cost of a 401k. And it's like, I hear you, but I also don't think it has to be as expensive as some places make it out to be. So don't let that be the deterrence overall. Make sure you're getting good quotes, getting good insight of how you could affordably set up a 401k plan.
Yeah, this is one to talk to a few. If you've got a payroll provider, they probably offer an option. Ask them. You can ask a financial advisor. A lot of them will set them up for you and just kind of shop around. But I mean, I had a client last summer. She set one up. It was under $1,000 for a solo 401k, which is like one of the lowest I've seen. And I was like, done. Like, don't even bother trying to find anything else. That's a done deal. And it's a deduction. It's a deduction to the business to set it up. There are still some retirement credits out there. So like there's still benefits for doing this for your employees if you have not done it yet. But in terms of still sneaking something in for 2025, if you have one set up, you were thinking about giving bonuses, I would start changing that discussion and shift it to maybe a profit share instead.
Yep. All right. For retirement accounts aren't the only lever we can still pull. So let's talk about HSAs.
Yeah. Health savings accounts. These are really good. You have to have a high deductible plan that qualifies. So that's like hoop one. So if you have that, though, you can personally open and contribute to an HSA. And
TRICARE is not a high deductible plan, in case for any of our fellow military people out there.
And if you are covered by TRICARE and your employer has a high deductible, also cannot do that. Don't ask me why, but you're not allowed to double dip because apparently that's not allowed. I think it's dumb, but I've been there. Yep. But yes. So you have to be in one. You have limits on whether the insurance is for yourself and for the family, but your contributions can reduce your taxable income. And that goes on your tax return if your like employer doesn't offer one. So let's like set this up. You have an S Corp. Your S Corp has your high deductible health plan that pays for you because you own that. You cannot have the S Corp contribute to your HSA and get the same power of deduction. It's actually considered a fringe benefit and it gets added to your wages. So what you want to do is personally go to the side and go open up as owner, lady, your own HSA and contribute to your HSA that way. You can still do it and qualify it for the last year. These can be extremely powerful accounts if you are very healthy, if you're not going to the doctor a lot, if you don't have a lot of prescriptions year to year, because this money can actually be invested and grow tax-free if you use it for qualified health reimbursements, copays, prescriptions. What else am I trying to think of? Glasses, contacts, like those things. The really cool part is once it's open, any expense incurred after that date can be reimbursed years later, if that's the case. So a cool story I'd heard was that somebody had opened them and faithfully contributed every year, never reimbursed themselves, waited many, many years. Balance had grown to $250,000. And at that point, they submitted $250,000 of a lifetime of receipts. And they all got tax-free because it was an HSA. The expenses were incurred after it was open, and they had kept the documentation. So they likely did not put in $250,000 if they had invested it. They put in much less than that and gained that benefit. So it's a pretty cool thing to do. And if you can offer it to your employees, even better. But if you can't and you just want to do it personally and you qualify, I would highly recommend setting them up sooner rather than later and contributing to it.
Yep. And just to lay that out a little bit, because it blew my mind the first time. So I kind of want to walk through that a little bit slower. So how you get to that same situation that Caitlynn just lined out. Every year you contribute to your HSA. So you're contributing, what was the limit? 7,000?
7,000 for an individual, I think. So,
okay. So let's say you contributed your $7,000 and it sits there. So you don't use it as the reimbursable account that it is. Like, oh, there's all kinds of things. Like as you buy on Amazon, it's like, you can use this as an expense, right? So you don't actually pull out and reimburse for that at that point. You keep all of those receipts. So you have to be diligent with the paperwork side of it. That's the hardest part. So you have to figure out how to do that piece. But over time, you just track all of those receipts. But you let that money sit there invested. Make sure it's invested. Don't let it sit in like government muni bonds or something like that. Like it must be invested in something good. So it's growing. And then as it's grown over time, you go back many years from now, you have all those years of receipts that you've diligently tracked. And that's where you get to say, look, I pulled all this money out and here are all the expenses that went with it over time.
Yep. So and every year, like you put in the 7,000, you reduced your taxable income by that. And then that money grew. It takes a lot. I don't even know if I would be that dedicated to do it. But I mean, I also don't qualify because TRICARE. But I think it just shows the power of some of these tools is not that they're flashy, is not that it's like, I'm saving you $20,000 this year. It's that you put in 150 and you reimbursed yourself 250. All of that was tax-free.
Yeah.
You never paid a dime on the earnings. You got to reduce your taxable income year after year for the amount that you put in. If you're a family, it's like double the amount. So it's closer to 14,000, 15,000. But even if you're putting in a couple thousand, it still will make a difference long term. And even if you do use it every year, then that's $2,000 that went in tax-free that you're paying. And you're reimbursing yourself for, and you didn't have to pay taxes on that money.
Yep. They're super powerful.
Yeah.
I'm jealous that I can't take advantage of it.
Me too. Because when you look toward retirement too, you're like, that's when you need it, right? When everything's so expensive and you're at the doctor all the time. So yeah, go get yourself, if you can, it's a reason to have like a high deductible plan is for this piece. And a lot of employers, to incentivize you, they'll contribute to it. Their contribution isn't a deduction to you, but still a benefit. But yeah, I love these things. I wish I had one.
And I think this just goes back to the piece that most tax saving strategies, most retirement planning strategies, they're not sexy. Like, they're just not. They're just boring decisions that you make over and over again, and you track things well, and you just keep moving on through time. And then all of a sudden you wake up one day and you're a multimillionaire because you made smart decisions.
Yeah.
I know that sounds dumb or it sounds boring, but it's literally how it happens. It all ties into, you've got to know your numbers. You got to have clean books in your business. You need to know your financials on your personal side. You've got to build the plan, make the plan, work the plan. Mm-hmm. And just do that, rinse and repeat year over year. And start early.
Yeah, start as early as you can. I mean, we at some point need to have a discussion around the new non-deductible IRAs available to kids, because I think that's a new tool that it can be super powerful. Because again, it's the time. If you can invest a few $1,000s now for your 5-year-old and just let it sit until they're 65, 60 years where you just get compounding interest on it. You don't have to do a whole lot of craziness. You have to have patience. You have to turn off TikTok, and you have to stop listening to the people who are telling you that you're missing out, because you're not. It's the average American, the average business owner. These are the tools that are going to make the difference both today and 20 years from now.
Yep. This is literally how you build generational wealth.
And that's the plan, guys, is the generational wealth. Save the money on the taxes here and there so you can build that generational wealth. But talk to the folks who didn't like strike it rich immediately. They did this slowly and surely.
Yep.
So with all of that fun, all of those tax savings, I hope that at the very least you learned that tax planning works when your numbers are accurate. Your books, as Seanna said, are up to date so that your professionals can help you help yourself. We can't do it without that information. SEP IRAs, traditional IRAs, 401k profit sharing, HSAs, they all can lower your taxable income. They're based on profit, on payroll, on strategy. And so having that information helps. When your books are current and someone is reviewing them throughout the year, you can have those discussions and options readily available as opposed to panicking. When everything gets cleaned up at tax time, you're reacting. You don't have the ability to be proactive. So if you want proactive, clear reporting, a team who understands you, we do recommend you book a discovery call with us. Let's see what we can do to help you. And that's at justprospera.com. The link is in the show notes. And we'd love to see you.
Yeah. Thanks for listening.